Okay, Chapter 14, Partnerships, their formation and operation. This is probably, for most of you, the first and maybe only time this in Chapter 15 where you get any sort of exposure to accounting for partnerships. So I thought I'd be remiss if I didn't cover these chapters. Not that things you haven't already learned don't apply to partnerships, because certainly how you account for assets, liabilities, revenues, expenses, gains, losses, and all that stuff certainly apply. But there's some things that are unique to partnership accounting that you won't see in accounting for other types of business entities. And there sure are, whether you're a staff accountant working inside a company or working at a public firm or, whatever. Seems like more and more these days you're going to have some exposure or need some exposure to this, because this type of accounting is pretty prevalent out there in the real world. So, without further ado, partnerships. What is a partnership? Well, it's defined as an association of two or more persons to carry on a business as co-owners for profit. So it's pretty broadly defined, and case law out there indicates that you can have a partnership and unintentionally have a partnership. There's a case out there in at least one business law book I've seen where you have the owner who likes collecting money, owner of a business, and the manager of the business convinces the owner that she'll run the company and take certain percentage of profits, and she makes the business wildly profitable. And so the owner comes to her some years later, like 5 or 10 years later, after the business has been grown by this person, and says he's going to sell it. And of course, he's going to sell it at quite a profit. And so she sues the owner, claiming that they were partners in this business. And the court agreed and looked at the definition and said this was an association of two or more persons carrying on a business as co-owners for profit. So you can very happenstance enter into an agreement to form a partnership. Doesn't necessarily have to be anything formal or written. There are quite a few partnerships out there. Certainly not as many as corporations, but by looking at the number of tax returns filed by partnerships versus corporations, still pretty big amount. Now, in considering whether or not to form a partnership, certainly have to consider the advantages and disadvantages of this type of business setup. And certainly, as most books do, we compare it to advantages and disadvantages of corporations. And so the advantages of a partnership, it's very easy to create. Really easy. You can define relationships usually in some sort of written agreement, but it doesn't have to be. You can be a general partner, you can be a limited partner, you can be a managing partner. Profits and losses and management operating decisions are shared independent of ownership percentages. So you could have someone who owns a pretty large percentage here of the partnership, and if you have like other partners who are active, they may own less ownership in the business, but if the parties agree, the partners who operate the business can share a larger amount in profits and losses. You can have non-participating partners and just have certain managing partners. So lots of flexibility can be in these partnership agreements. Very easy to form a partnership, very easy to dissolve a partnership. One of the main advantages of a partnership is the fact that the income, expenses, gains, losses of the partnership flow through to the various owners, partners. And so by doing that, you avoid double taxation that you would get with a corporation. And I'm not going to go through the example they have in the book, but when you have a corporation, a C Corp, you're going to have two levels of taxation, one at the corporation level, and then since you pay dividends with after-tax earnings, you're going to have a tax at the shareholder level, usually, when you pay a dividend to those C Corp shareholders. Now, Congress has sought to try to alleviate some of the double taxation burden by taxing a dividend income at a lower rate, but still, most individuals who receive dividends are at least going to pay 15% and maybe 20%, so it's still going to be a higher effective tax rate because taxation is at two levels. The other thing is because of this flow through to the partners, any operating losses can be used to reduce personal taxable income, and compare that with a C Corp. If they have an operating loss, since they're a separate legal entity, that doesn't flow through to the various owners of the corporation. Disadvantages. The main disadvantage of a partnership is the fact that each partner has unlimited liability, and so they are what they call joint and severally liable, meaning any one of them could be liable, or all of them could be liable for the debts of the partnership. Just like you've probably seen with sole proprietorship, the same idea is applicable here with partnerships. And so, because of the unlimited liability, each partner's personal assets could be at risk. Another problem is this thing called mutual agency. And what it means is each partner has a right to incur liabilities in the name of the partnership. Why that could be a problem is, well, see above the unlimited liability problem. You might have a rogue partner out there incurring needless debt in the name of the partnership. And again, one of the other problems here is with partnerships, you don't get some of the same perks that you get with corporate tax benefits. I think what they're talking about there is like health plans and things like that. Deductibility of health plans. There have come along some alternatives to partnerships, some hybrids that have some of the features of partnerships for tax purposes, but have some of the characteristics of corporations for liability purposes. So some of these help alleviate that unlimited liability problem that you have with pure partnerships. And so one of those is called a subchapter S corporation. In order to become an S corporation, you have to incorporate in some state here in the United States. And then with the Internal Revenue Service, you have to apply to become an S Corp. In order to be an S Corp, you have to meet certain requirements. One of the main ones is that you can only have 100 shareholders in the corporation. Only certain types of individuals can be shareholders. And so individuals can be shareholders, estates, certain tax-exempt entities and trusts, but you can't have a corporate shareholder being a shareholder. You can't have a corporation being a shareholder. Now you can have an S Corp owning stock in a C Corp, but not vice versa. And so, again, the advantage is the pass-through. Profit passes and losses passes to the owners, the shareholders, just as it would with a partnership. So You get the legal protections of a C Corp with an S Corp and the tax benefits of a partnership with an S Corp. So pretty good deal, but there are some limitations here. Also, the shareholders, it doesn't mention it here, but shareholders have to be like U.S. citizens or residents. In other words, you want to sell to a Canadian or something like that, you're not going to be able to do so because they are not U.S. citizens. Another alternative is becoming a limited partner in a limited partnership. The problem there is limited partners are not allowed to participate in management, and if you've taken tax, you probably know this. If you have losses and you're a limited partner, your losses are restricted to the amount invested because you don't materially participate in the management of the limited partnership. Now, even in a limited partnership, you have to have one or more general partner to assume responsibility for all the obligations. Usually when you set these up, you create like a corporate general partner that is fairly thinly capitalized, so even though they assume responsibility for all obligations, they don't have a whole lot of capital invested in them. One that's used with professional organizations such as accounting firms and law firms and medical firms is the limited liability partnership. Now, they risk their own investments. That's not a surprise there. Certainly are responsible for the contractual debts of the business, but the nice thing is that they're liable only for their own acts or omissions and those of people that they directly supervise. But let's say they have multiple offices, such as in a large accounting firm. In that case, someone on the West Coast is not going to be responsible for a negligent decision made by someone on the East Coast, for example, if they're both partners. A recent kind of business form that's becoming popular is called the limited liability company. And these are classified as partnerships for tax purposes. And the nice thing about LLCs is that the problems you have with an S Corp as far as ownership, both, the U.S. citizen thing and the number of shareholders, you don't have that problem with LLCs. So, and you can have as many members, as they're called, in an LLC as you want. Members are the owners. And of course, they're always at risk on their own investment. Now, the thing that's unique about partnership accounting is the owner's capital accounts, the partner's capital accounts. In corporations, you're going to have shareholders' equity, and FASB requires that to be accounted for, segregated out into its various forms: common stock, additional paid-in capital, retained earnings. Here, you don't have any of that. You simply have each partner's capital account, and their capital account consists of their initial contribution, their share of any income or losses, and any withdrawals that they make. So from that standpoint, it's fairly simple, but it's fairly unique, which is why I feel the need to talk about it. So profit and losses for each period are allocated to each partner's capital accounts. The withdrawals by partners reduce their capital accounts, of course. And understand this, that income and losses do not have to necessarily reflect ownership. As we talked about, I should say the distribution of profits and losses do not have to necessarily match the ownership interests. I mentioned a while ago that if you've got a partner, let's say, who is non-participating but has a fairly large ownership interest, let's say 60%, and let's say you've got another owner who owns the other 40%, but is active in the day-to-day management of the company, as long as they agree, the 40% owner could take a larger portion of the income each year. And so there's a lot of flexibility here with these partnership agreements. The book calls this partnership agreement articles of partnership. I'm not sure where they came up with that term. None of this, there's this thing called the Uniform Partnership Act, and its follow-up, which is called the Revised Uniform Partnership Act. And each state has adopted this act into their statutes. But what you have to realize is that UPA and RUPA, as they're called, are only effective to the extent that some issue is not covered in the partnership agreement, what they call articles of partnership. So when I say partnership agreement and they say articles of partnership, just realize that I'm referring to the same thing they're referring to. They're one and the same. Going back to disadvantages of a corporation, what do you have to be a corporation? You have to file something with the Secretary of State in the state you want to be incorporated. You got to pay a fee. You got to file your articles of incorporation. You have to have shareholders. You have to have a board of directors. You have to have regular meetings. There's a lot of stuff that you have to do to be a corporation required by law. Not so much here. But it's kind of important that certainly when you're advising clients who want to be partners, they need to get this in writing. And as the book points out, the accountant can be a big help in deciding how they want to move forward with this agreement, what they want to have in it. Certainly it's not going to be up to the accountant to draw up this agreement. Either the parties, the prospective partners, have to draw it up, or a lawyer has to draw it up, because you don't want to be accused of performing legal work without a license. That would be bad news, because that's a crime. All right, so let's talk about this, describing the purpose of the articles of partnership and the list of specific items that should be included in the agreement. So UPA establishes standards and rules for partnerships, but a written agreement will supersede UPA standards. So UPA and RUPA are fallbacks. If your agreement doesn't mention a particular issue, doesn't address a particular issue, then you look to UPA or RUPA to see what it says. Now, some basics are name and address of each partner. That makes total sense. Business location, nature of the business, the big ones. Rights and responsibilities of each partner. And there you have to get pretty specific. Now, how specific? Each partnership agreement is going to be different, but let me just tell you, in my experience with partnerships, it's kind of like a prenuptial agreement. You have to formulate this partnership agreement with an eye towards a potential divorce of the partners, because not saying it happens all the time, but it sure as hell happens a lot. So, take my word, I've been there, I've done that. Your good friend going into the partnership is probably going to be your worst enemy coming out of the partnership. So each one needs to protect themselves by making sure that the provisions of the partnership agreement are what they want. Now, there's going to be some give and take, obviously, but everything's subject to negotiation. But there's some lines you just can't cross either way. Initial contribution to be made by each partner would be important. The method to be used for valuation, both for what's contributed initially as well as any subsequent contributions, as well as coming out, dissolution of the partnership, how that's going to be valued, the method. You might have something in there about what happens at death. Worst thing you can do is have an unwanted partner in the partnership. We'll talk a little bit about that here, but might want to have some key man life insurance on on each partner, so that in the event of a partner's death, the partnership has the liquidity, or the other partners, to buy out the deceased partner's interest. So, I mean, these are just basics. You can put all kinds of stuff in there. Certainly you need something in there about how profits and losses are to be allocated. There's got to be something in there about withdrawal of assets, cash draws that each partner is going to need at times. Again, you don't want new partners, unwanted new partners, so some procedure for admitting new partners. How do you settle disputes? Well, best thing to do is have an arbitration clause in your partnership agreement so that you don't have a lot of needless litigation running up legal fees for both partners and the partnership. Again, life insurance policies or provisions enabling remaining partners to acquire the interest of a deceased partner. And again, method for settling a partner's share in the business upon withdrawal, retirement, or death. All right, so how do we account for capital contributions? Here we have an example of two partners forming a business operated as a partnership. One contributes $50,000 in cash and the other $20,000 in cash. Pretty simple. Debit the cash. As far as the credit is concerned, you're going to credit each particular partner for their capital contribution. So Carter Capital, $50,000. Green Capital, $20,000. Pretty easy, right? No big deal. The question that the book goes into is, well, should we account for non-cash items using the non-cash items fair market value at the time of the contribution, or should you use its basis? And the quick answer is you use fair market value, because when someone contributes cash, I mean, everybody agrees that the fair market value of cash is whatever the face value is. In our previous example, it was $50,000. But what if in our previous example, that person provided land with a building on it with a basis of 20 but a fair market value of 50? Should they, because they contributed non-cash assets, be hampered by that fact and only have their capital account credited for $20,000 instead of $50,000? And most people would agree that that's unjust. And for that reason, we would credit the contribution of non-cash property at its fair market value, in my example, $50,000. Well, here they have an example of Green, instead of contributing $20,000 cash, here they contribute 3 separate non-cash items with a book value of $55,000 total, fair value of $67,000 total. And on top of that, one of the items, the building, has a mortgage that secures the building. And so what happens there with the mortgage is, once the building and the mortgage are contributed to the partnership assumes the mortgage. And so it's as if Green is getting relieved of that debt, or at least half of it. But the bottom line is that the $23,000 mortgage that Green's relieved of is subtracted from the fair market value of the non-cash property that they contributed. So $67,000 minus $23,600 mortgage, and so their capital account is going to be the difference between those two of $43,400. Well, how do you handle intangible contributions? Let's say I don't have a lot of money or non-cash property, but I do have a lot of talent that I can bring to an organization, and the other partners or other partner realize the value that I bring, the intrinsic value that I bring to the organization, and they want to make me an equal partner. How would that be recorded? And so contributions made by one or more of the partners may go beyond assets and liabilities, or at least tangible ones. So, for example, a particular line of expertise or established clientele. When you have this sort of situation, you have two options. You can use what they call the bonus method, or you can use the goodwill method for recording this contributed intangible asset. So we have an example here. James and Joyce open an advertising agency and organize as a partnership. James contributes cash of $70,000. Joyce invests only $10,000. So $10,000 cash. Joyce, however, is an accomplished graphic artist, a skill that is considered especially valuable to the advertising business. James and Joyce have contributed a total of $80,000 in identifiable assets and have decided on equal capital balances. So how would we handle this when only $80,000 of identifiable tangible assets have been contributed? Well, it's going to be as if James, even though he contributes 70 of the 80,000 here, turns around and gifts, if you will, a portion of his contribution to Joyce. And here they're equal partners. I don't see anything in here that says they're not. What you're going to have is an equal distribution here. So 70 of the $80,000 cash, of that 70, only 40,000 is recognized in James's capital account. It's as if he gifted the other 30,000 to Joyce. Remember, she contributed 10,000, so that makes her capital account now 40,000. So she's receiving what they call a capital bonus of $30,000. Now we could do this the goodwill method way. This is based on the assumption that an implied value can be calculated mathematically and recorded for any intangible contribution made by a partner. In the present illustration, Joyce invested 10, 60 less than James, but receives an equal amount of capital according to the partnership agreement. And so Joyce's artistic talent has an apparent value of $60,000, a figure that should be included as part of the partner's capital investment, her capital investment. If not recorded, Joyce's primary contribution to the business is ignored completely within the accounting records. So here we record our cash of $80,000, but instead of James taking part of his capital account and giving it to Joyce, he's receiving his $70,000 that he contributed, and we're creating a debit account, an asset account called goodwill, and valuing that for the $60,000 of artistic talent that Joyce brings to the partnership. And so her capital account reflects the $10,000 that she contributed in cash plus the $60,000 of artistic talent that she's bringing to the partnership. So either way will work. The book seems to indicate that compare this with the acquisition method of determining goodwill. There, cash is expended for the purchase of a company, right? And so, these are arm's length transactions that we're dealing with in acquisitions. So, I mean, we have some objective decision making going on in determining the purchase price of a company. Here, it's based solely upon the parties' agreement. Now, you might say that, well, it's still arm's length, and maybe it is, maybe it isn't. But anyway, the book indicates that maybe if you see a partnership that has goodwill in it, that maybe it's not quite as genuine as it represents. I don't know how true that is, but I'll take their word. Okay, so next we want to talk about allocation of income. show you the impact that the allocation of partnership income has on partners' individual capital balances. So, partnership revenues and expenses must be closed out at the end of each fiscal period, and the net income or loss allocated to each partner's capital account. Some method must be devised for the assignment of income or loss. That's where you look to the articles of partnership or the partnership agreement to determine what the established procedure is for that partnership. If no arrangement is specified, then you have to look to state partnership laws which dictate that all partners receive an equal allocation of income or loss. Now, what happens if the partnership agreement talks about how income is supposed to be allocated but not loss? Well, you look to the partnership statutes, UPA and RUPA, that states that if there's no allocation in the partnership agreement concerning losses, you simply divide them in the manner that the partnership agreement outlines for the distribution of or the allocation of income. So if, let's say, your partnership agreement between two partners was 60-40 income but doesn't address how losses are going to be allocated, simply know that UPA and RUPA say that you're going to divide the losses how they would have divided income, so it would be 60-40. Simple as that. So we have here an example. Tinker, Evers, and Chance form a partnership by investing cash of $120, $90, and $75 respectively. Evers, the middle guy, will be allotted 40% of all profits and losses because of their previous business experience. Tinker and Chance are to divide the remaining 60% equally. This agreement also stipulates that each partner is allowed to withdraw $10,000 in cash annually from the business. And so net income in this first year is $60,000, or yeah, $60,000. How are we going to distribute that? Well, you're going to be closing this out from income summary, the net income, into each partner's capital account based upon their agreement. So 30%, 40%, and 30%. Note here that this allocation dang it. What they've done, if you look on page 640, they don't show in this example the draw account that you're going to have. Now, this example should have said that you assume that each takes out their $10,000, okay? And so before you get to this journal entry, you're going to have a closing entry to close the draw account. They call it drawing, but most people I've heard call it the draw account. You're taking a draw off of income or off your capital account in this case. And so draw accounts reduce each partner's capital account. Well, each partner here during the year took a draw of $10,000 per the agreement. And so you create this temporary account called the draw account for each partner. But at the end of the year, you close those draw accounts because they're temporary. And you have to, the other part of that entry is you're going to reduce each partner's capital account. So that is your debit. So for each one of these partners, they have a debit, a reduction in their capital account of $10,000. So you have to keep that in mind, make sure you look at that in the book. So down here at the bottom, they show the effect on the capital accounts for each partner of the allocation of net income that you have here, 60,000, 18, 24, 18. But their capital account was also reduced by the 10,000 draw each one got during the year. Now they have a couple of alternative allocation techniques here. And what these have to deal with is, and again, you can have stuff in these partnership agreements, it's kind of endless. I mean, what we saw before in the previous example dealt with draws and distribution of income based upon percentage of ownership. But it doesn't necessarily have to be even. So, you know, it's kind of whatever the parties agree to, it's fine with me. I'm just the accountant. All right, so some other things that might come into play are, partners who contribute a substantial amount of capital might want to get some sort of interest allocated to them on their contribution of capital for the year. The other thing is, somebody who puts in more work into the partnership may want some sort of salary out of that as well. And so, again, the allocation of income is not necessarily based on relative capital balances. These are separately negotiated items. So if you have this sort of deal, you can, allot the income based upon interest on beginning capital balances or on average capital balances. Certainly you could allocate a certain amount of the income to compensation, and then any remaining income would be allocated however the partners have agreed. Okay, so here we have an example. Hopefully it's complete. And so we have Tinkers, Evers, and Chance again. Original facts, except an article of partnership agreement credits each partnership or partner annually for interest equal to 10% of that partner's beginning capital balance for the year. Evers and Chance will also be allotted $15,000 each as compensation allowance in recognition of their participation in daily operations. Any remaining profit or loss will be split 4-3-3, meaning 40-30-30%, with the largest share going to Evers because of the work experience that this partner brings to the business. Well, actually, that's not true, what I said, because Evers isn't the 40% owner. Tinker is, right? But yet, Tinker's only, look, Tinker is a 40% owner in the partnership, but their agreement is that he only get 30%. Evers, since he's more experienced, gets 40%, even though he's a 30% owner. And Chance is both 30% owner and is getting 30% of any remaining income after payment of interest on the capital account as well, or interest on contributed capital, and after compensating balances to both Evers and Chance, who are materially participating. Tinker is not. So that's kind of what I was saying before. The agreement to distribute income doesn't necessarily have to be what each party's interest in the partnership is. It can be different. Now compare that with corporations and even S-corps. S-corps are prevented from doing this kind of stuff. Profits and losses are distributed pro rata based upon each shareholder's ownership interest. Here, totally different. So anyway, in this case, they have, again, $60,000 income. If you look at the example here, again, Tinker contributed $120,000 capital, so he's getting 10% on his beginning capital. So 12,000 of that is 10% of 120. Evers, 10% of 90, and Chance, 10% of 75. Of that $60,000 of income they earned, the total of these three equals $28,500. So that leaves what, $31,500 to allocate. Next, you have to allocate the compensation allowance, $15,000 each to Evers and Chance. That takes up another $30,000. So you've got, after all this, these two things, only $1,500 that you have to allocate. And so you allocate that $1,500, 30% to Tinker, 40% to Evers, and 30% to Chance. So that's your allocation. So what does that leave you with? Well, only $12,450 in Tinker is added to his capital account, $24,600 to Chance Evers' capital account, and $22,950 to Chance's capital account. A note here, the assignment process is merely a series of mechanical steps reflecting the change in each partner's capital balance resulting from the provisions of the partnership agreement. So the partnership agreement is the first thing to look at in determining how you're going to account for certain things. And so the book points out that although interest compensating balances or compensation allowances and various ratios are predominant in the practice, other possibilities exist. Therefore, another approach to the allocation process is presented. And so they don't have it here, but let me just kind of go over it. In example 2 on page 641 and top of 642, you have a new example. And so here, each one is allowed, it's a wholly new example, by the way. And so you've got Weber and Rice forming a partnership. And so some of the more pertinent provisions of the Articles of Partnership are that each partner is allowed to draw $1,000 in cash every month. Any withdrawal in excess of that figure is accounted for as a direct reduction of the capital balance. Partnership profits and losses will be allocated each year according to the following plan. Each partner will earn 15% interest based upon the monthly average capital balance for the year. Rice is to receive credit to a bonus equal of 20% of the year's net income. I think Rice is the one who's going to manage the business. Weber's the one who's going to provide the capital here, a bookstore. And any remaining profit or loss is divided equally. And so you have this interest allocation based upon the average of the let's see what they do here. Oh yeah, they're paying interest based upon a monthly average capital balance. And so they have in this instance one of the partners, Weber, contributed $8,000 more in 4/1 of 15, while at the middle of the year, the other, Rice, took $6,000 more and that was accounted as a direct reduction to her capital balance. And so it just shows how they calculated the monthly average capital balance. Other than that, I mean, it's pretty cut and dried. Kind of what you saw in the previous example. All right. Tomorrow or the next day, I'll do another lecture and finish out this chapter.